I'm still betting on silver to outperform all of these other things so that when we get to a top, I can acquire a whole lot more of these other things than I'm actually paying for. The silver gave me the leverage.
Well, look, I'm waiting for triple-digit silver.
Okay.
So,
okay, there you go.
I think I was asked in January, February this year what my prediction was for the end of 2025, and I said $40, or at least I think I said $40, and we blew through that like butter, I think we're going to see new highs. I think we're so close to $55 last week that the market just had to kind of do one more sell-off, just drive it down a little bit. And it's destined to go through new highs here. And, whether it hits 60, 65 by the end of the year, I wouldn't be all surprised.
Silver continues to stand out as one of the strongest long-term opportunities in a system showing clear signs of stress and transition. As layoffs accelerate, commercial real estate cracks widen, and consumer sentiment sinks toward multi-decade lows, the underlying message is that the real economy is weakening even before the official recession begins. At the same time, silver has already pushed through key resistance zones, approached new highs, and demonstrated the kind of momentum that typically precedes a significant breakout. With structural deficits, declining affordability, and credit instability converging, the environment increasingly favors hard assets that preserve purchasing power. MikeMaloney, a longtime educator on monetary cycles, and Keith Neumeyer, one of the most influential figures in the silver industry, note that these conditions create the backdrop for silver to outperform dramatically, including the potential to reach $100 in the coming cycle. With demand rising, supply stagnant, and retail interest hitting record levels, silver's leverage makes it one of the few assets positioned not only to weather the downturn, but also to benefit from it. Both analysts emphasize that this setup offers a rare chance for ordinary investors to secure real value amid historic economic imbalances. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We start here with the top 10% of American households own 87% of all stocks, nearly 85% of all private businesses, and 44% of real estate. And I love the way this is phrased. Another way of looking at this, the bottom 90% in America increasingly don't matter in official economic data. When you don't get assets, you're squeezed out. You just simply miss out on the rest of the so-called economy.
Yeah. And the one way for somebody that doesn't have a lot of resources to start with, you have to find something that you think is going to outperform the other asset classes. Sort of focus on that thing. For me, it has been silver, gold and silver. And, this century so far has proven me right. I'm still betting on silver to outperform all of these other things so that when we get to a top, I can acquire a whole lot more of these other things than I'm actually paying for. The silver gave me the leverage.
U.S.-based employers announced over 150,000 job cuts in October alone, the highest for any October since 2003. So this even exceeds the pace seen during the Great Financial Crisis, all those Octobers, 2008, 2009. Okay, we had even more layoffs this October. Year to date, over 1 million layoffs have been announced. The U.S. job market is struggling. So maybe it makes sense to look at all the layoffs recently. Look at all these companies. UPS, 48,000 employees. Amazon, 30,000, and so on. This is a long list. And it's not good.
Yep.
The labor market is clearly weakening. I would agree with that. My business cycle model has never been wrong. The leading economic indicator index, it's crossed into negative territory. And so a recession has come every time that has happened since 1950. Pretty long time. Not too many signals, not missing any recessions. So the LEI is now the most negative we have seen it since the late 1970s. And so basically, when it goes that far negative, we get a recession every single time.
Except for the global financial crisis, right? But one thing, when I was looking at this earlier, the spread between the red line and the blue line right now is larger than at any time except for the global financial crisis. If you go to the 2002, that one, the spread there, the blue line is already below the black center line, and it's the bottom of that dip is not as low as we are now. So that was the other than the global financial crisis, where the information falls right off the bottom of the chart. So we actually don't know what the spread was. This is the largest spread. When does the data start? In the 70s sometime.
Yeah, here's the 1970s. Yep.
76 or something.
Yeah.
Amazing.
So leading economic indicator. Speaking of taking that same indicator, comparing it with the S&P 500, the leading economic indicators have never missed a recession signal, not once. Every single time the S&P 500 has followed with a sharp correction. This time the signals are flashing red again. Is it really different now? I'm not betting on that.
Real economy and the financial economy basically diverged. When does this last green one start? What's the date on the bottom there?
2022.
2022. So that is how long Main Street has been diverging from Wall Street.
Yeah. Yeah, it looks like a little over 3 full years. Yep.
Wow.
Long time.
So another thing saying that when this happens, it's going to be bad.
Unfortunately, I don't want it to happen, but I mean, these things are out of my control. So all I can do is get prepared and educate as many people as possible. Next up, breaking the delinquency rate on commercial mortgage-backed securities for offices surged 63 basis points in October to a record 11.8%. This is now over a full percentage point above the 2008 financial crisis peak of 10.7%. So look where we are way up here. We've never been this high before. We're higher than all the crises before.
Yeah, another thing I'd like to point out again is the steepness and it's pretty steep after 2009 during the global financial crisis. But at 7%, it sort of levels off for a little period of time and then rises again. Look at the move that we have made since the beginning of 2023. So this is less than 2 years of data. We have moved from 1.7% or something like that, all the way up to over 12. This is, or no, not over 12, 11.8. So this is, this is really going to be bad when it happens. This is one of the triggers. It's one of those things that is laying in wait. And these commercial mortgage-backed securities are going to crash to zero, just like the regular residential mortgage-backed securities did back in 2008.
Yeah. I think so too.
Bailouts by the Fed. I mean, this is destined to happen.
Exactly. And all the bailouts are going to make all the problems that much worse, for the little guys. So
yeah, this is a result of them papering over all the cracks last time with currency. Just type currency into existence.
Exactly. It's a shame. Housing data shows home sellers now outnumber buyers by more than 500,000. That's the largest imbalance ever recorded in the real estate market. Home sales are headed for their worst year since 1995. That's 30 years.
Oh, okay. So this person has data going back to 1995, but this only shows it going back to 2012.
Exactly.
Okay. Yeah, because it says largest imbalance ever recorded in the market. There's probably no data available for the stock market crash of 29 and the Great Depression, but I'll bet on a percentage basis, it was even larger. So,
probably.
But again, the crisis hasn't started yet. This is already in place before something triggers the crisis. And so real estate, both commercial and residential, is really headed for something bad here. I want to point out one more time also that in 1929, it was the stock market that was overvalued, not gold, and we weren't in a real estate bubble. In 1966, the stock market got overvalued, and we had something called the invisible crash, where the stock market, the Dow bumped its head on 1,000 points in 1966 and couldn't break through until 1982. But during that period of time, we had raging inflation. Company revenues doubled or tripled during that 16 years, and that caused PE ratios to go back to extreme undervalued by 1982. They were overvalued, all of the indicators, Buffett indicator, PE ratios, and so on, said that the stock market was in a bubble in 66. It worked its way off. Then we went into a severe bubble in 2000, and everybody knows how the crash of the NASDAQ worked out, the tech bubble. And that was, again, a stock market bubble, but not a real estate bubble. Then in 2008, the global financial crisis the stock market was not in a bubble. It was slightly overvalued, but not much. During the tech crash of 2000, we came back down to almost reasonable valuations. They were a little bit high, but the stock market was not in a bubble. That was a real estate crash that dragged the stock market down with it. This time, we are in a stock market bubble and a real estate bubble of historic proportions just before some sort of big financial crisis. And it looks like we are in the midst of a monetary reset. This is going to be horrific.
Almost never in the history of the U.S. economy has consumer sentiment been so depressed. U.S. consumer sentiment fell to 50.3 points in October, the second lowest ever. It's now 10 points below the great financial crisis and below all recessions that we've ever had. What kind of crisis is this?
Well, and the crisis hasn't started yet.
Not officially.
And this data goes back into the 70s. So you get a real good, historic reference here. Wow. This is really, really bad when you add all of these things together.
Yeah, it is. Okay. It is. I wish we could help people, but that's what we're doing here every day.
Well, this is how you help yourself right here.
How do I buy silver, right? How to buy silver on Google hits a record high. Look, this looks like all the other charts, right? We're higher now than we were during the financial crisis. If I didn't tell you what this was, you'd think there's a pattern here. It's how do I protect myself from all the economic shenanigans?
Right. And the good thing is that this is happening before the big crisis hits. The stock markets and real estate have not begun to crash yet, but it is time to get prepared. And I think it's good that people are actually. And basically, this has been caused by the price run up. So this is the people with the fear of missing out, the people chasing price, not the people getting prepared.
The latest surge in silver demand reflects a structural shift that extends far beyond short-term price action. Unlike the 2011 spike driven mainly by paper shorts covering, today's market is fueled by genuine physical demand, shrinking inventories, and a tightening supply chain that has run multi-year deficits. Industrial consumption continues to rise while recycling remains minimal, leaving above-ground stocks under growing pressure. At the same time, economic stress across the broader system is accelerating. Job cuts are climbing at a pace not seen in decades. Commercial real estate delinquencies have surged to crisis levels, and consumer debt strain is rising sharply. These trends point to a weakening foundation beneath the economy long before the official downturn begins. As financial indicators deteriorate and asset bubbles stretch to extremes, silver's role as both an industrial necessity and a monetary refuge becomes increasingly central to the unfolding cycle. Let's get back to the interview.
I remember the move, that took place between 2009 and 2011. And, when silver broke out, through $30, back in early, I guess it was, early 2011, that whole move from $30 to $50 is basically short covering. The banks got completely caught offside. That was all paper driven. And that's why it ended so quickly, because it was driven by short covering. And this rally that we've seen over the last few months is all physical demand. It's completely different. People are waking. The United States government is deemed silver as a critical mineral, as you probably know, and I think that woke up a lot of people. And people are now saying, "Hey, look, this metal is really, really important for things like this." And we're not going to travel, we're not going to be able to drive, we're not going to be able to operate our homes, or whatever the case may be. Silver is a very critical metal. And people are waking up to that fact. So it's pretty exciting to see. It happened a little more quickly than I would probably liked, because it did get a little bit parabolic, and it needed to see a correction, and we're seeing that now. But it's going to settle, and who knows what we'll end up with at the end of the year, but likely higher than it's currently trading. So the central banks have been really the driver behind the gold price, and they've been in the market now for a couple of years, and they're just buying a whole bunch of gold, as you know. And so silver took a little bit of time, because people were waking up to gold and seeing it hitting new highs all the time. And what's the brother to gold? Even though I don't look at silver as I do look at gold, I think they're totally different. I look at gold as a currency. I look at silver as an industrial metal that's required for all the things that we need to do, electrifying the plant and so on and so forth. So I treat them differently. But the market woke up to it. So it was quite exciting to see. Well, I think it started with the tariffs, going back when, during Trump, when Trump was talking about tariffs in the U.S. And so a lot of the metal moved from Europe to New York or the United States, COMEX or whatever. And that included silver as well. And then all that had to be unwound, quite quickly, because all of a sudden the London market starts to get issues with deliveries. And interestingly enough, if you look at the Shanghai numbers, and because I see the Shanghai reports every week, and Shanghai warehouses are now down to 2015 levels. Which is crazy. So, this silver is being consumed in industry and is being moved around, and it is a bit of a bulky metal, and but it does get consumed, and that's different, as I said earlier, than gold, and because you don't recycle cell phones, you don't recycle computers. A lot of this silver that we consume just gets thrown in waste dumps. And it's getting a real problem. And we've now had 5 years of deficits in the silver market. The deficit on a combined basis over that period of time is close to 1 billion ounces. The miners are only producing about 850 million ounces a year, and we're consuming like 1.2 billion. So these ounces are coming from somewhere. They're coming from investment hordes or governments, but that's going to end. And we have to see higher prices too. And I've said it a dozen times to get the miners, the mining companies, to start producing more metal to fill that gap. But we're not going to do it at $50 silver. I think I was asked in January, February this year what my prediction was for the end of 2025, and I said $40, or at least I think I said $40. Yeah. And we blew through that like butter. I think we're going to see new highs. I think we're so close to $55 last week that the market just had to kind of do one more sell-off to drive it down a little bit. And it's destined to go through new highs here. And, whether it hits 60, 65 by the end of the year, I wouldn't be all surprised. Yeah. I think we're close to 40. I think just slightly shy of 40. I think we beat the COMEX by maybe 50 cents or something. It did spike a lot. End of September, in October, we saw basically $55 silver. And, I think that our Q4 average will be probably much higher, I would expect. With all the different acquisitions that we've been seeing in the silver space, it's getting tight out there. And, we spent a lot of time looking at the juniors, and we're invested in some of the juniors already. What our next M&A transaction looks like, I can't really comment on it today, but, we were quite active. We don't want to become a gold company, we see, many of the other players in the silver industry becoming gold companies. We're trying to prevent that as best as possible. By getting Jerritt Canyon up, it will obviously add some gold ounces, but, right now we're at 57% silver. We're the purest in the silver space, and it's important to us. We're trying our best to keep it up to those levels.
U.S. serious credit card delinquencies are at crisis levels. The share of U.S. credit card balances 90 days or more delinquent rose to over 12% in the first half of this year, the highest level in 15 years. The only time that this level was higher was during the financial crisis. And look how quickly it's going up the last few years. Very, very fast.
And isn't 12% about 1 out of every 8 people?
Yep.
Wow. 1 out of every 8 can't pay their credit cards on time. This is amazing. And it's accelerated since 2022 when the stimmy checks stopped, right?
Yep, exactly.
Right.
Rising very quickly, could easily overtake the global financial crisis. We'll see.
And it will, because the crisis has not even started yet. This is the speed bump on the way to the main event. It's the prelude to the crisis. And so you're starting a crisis at these high levels.
Exactly.
This has never happened before. And it just shows you how bad the crisis is going to be when it hits.
Americans are falling behind on their car payments at alarming rates. Subprime auto loan delinquency rates reached 6.4%, the second highest on record. And the 60-day delinquency rate for subprime auto loans has more than doubled over the last 3 years. So look where we are.
It's the second highest on record, but the first highest is just, a year ago?
It looks like it. Yeah, they're grouped together pretty closely. So Yeah.
So this is this whole century. Wow. Look at how, it peaked, the global financial crisis peaked at 5%. And then what was going on in 2018, 2019, and 2020? I mean, it shows you that there was really something brewing before COVID happened and allowed them to paper over the cracks using this global emergency as the excuse. Something was going on back then, but to be at these levels, and the crisis hasn't even started yet. We haven't had a stock market crash. We haven't had real estate crash yet. I say yet because I'm pretty sure that there's something. I'm surprised it didn't happen in October. October is usually that spooky month. We may have a springtime crash this year. Who knows?
Yeah. Yeah, exactly.
I know that I would rather be ready for it and be years early than one day too late. And even though I feel like I'm years early, I'm still invested in the best performing asset class of the century, other than cryptos. So
exactly. Next up, car seizures due to not making the required loan payments are at their highest level since the global financial crisis. And you can see up here, we're at about 1.7 million cars repossessed last year.
And we will see what the next data point is next year, but because 2025 hasn't finished yet. But I'll bet that we are way above the global financial crisis levels.
The broader picture forming across the economy points toward an environment where underlying stresses can no longer be dismissed as temporary distortions. Silver's rapid ascent, persistent deficits, and tightening physical availability reflect a market adjusting to years of suppressed prices and rising industrial demand. Meanwhile, the economic backdrop shows unmistakable signs of strain. Deteriorating consumer credit, rising delinquencies, weakening employment metrics, and an expanding divergence between financial markets and the real economy. The convergence of weakening fundamentals and growing interest in hard assets suggests that the shift underway is structural, not speculative, and will likely define the next chapter of this financial era. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.